Hi, thank you. Good afternoon, everybody. Today, I will share with you our outlook on China and the Hong Kong market. And I will also spare some time on the DLC market, the daily leverage contract. They are listed in the Singapore with Hong Kong underlyings. So we'll explore whether there's any trading opportunities among those those DLC with Hong Kong underlying. And I think now most investors have the same question in mind. That is, how long will this bear market last? Although we don't have a definite answer, we'll try to use to refer to historical data to make a guess to estimate how much lower the stock market can get to. Okay, so first of all, let me show you this risk disclaimer. Okay, so these are the key discussion points I'll go through with you today. Review of China and Hong Kong stock market up to yesterday, overview of China's economy, and 2022 outlook. Chinese yuan outlook, I think a lot of investors will focus on that because there seems to be continuous depreciation pressure on the yuan. And then our Q4 index targets. Lastly, I would share with you our views on the Hong Kong underlying that have DLC being issued in Singapore on the SGX. Okay, so it was a bad year so far. Shanghai Composite Index was down 18.3% up to yesterday. It was on holiday for 1 week for the Golden Week, the National Day holiday. But after the resumption of trading, the Shanghai Composite Index dropped below 3,000, the 3,000 psychological threshold yesterday. It closed at 2,974 points yesterday. The Shenzhen Component Index fared worse than the Shanghai Composite Index. It was down nearly 30% up to yesterday. Okay. For the Hong Kong market, the Hang Seng Index was down 26.4% up to yesterday. But today, we saw a new year low. The index dropped below the 17,000 level again today, reaching a new year low at 16,820 points. Okay, so you can see in this chart that over the last few months, the main trend was still clearly a downtrend. Although there are occasional rebounds, yet the rebounds are very brief. The one we saw last week was after the Chongyang Festival holiday last Tuesday. So Wednesday, the Hong Kong market, the Hang Seng Index was up more than 1,000 points, giving a brief excitement to bulls here. But subsequently, because of the US market weakening, the Hong Kong market also followed the US market to trend lower, and now it was down. It has dropped below 17,000 again. Okay, the Hang Seng Tech Index fared even worse. The index was down 40% year to date, up to yesterday, and saw continuous new lows. Yesterday, the new year low was hit at 3,382. So there was the how the indexes, the China Asia indexes and the Hong Kong major indexes fare so far this year. Okay, behind the drop, amid this bear market, there are these headwinds that pressurize the stock market. And these headwinds, I think you remember I mentioned many of them in my last presentation. So a lot of them still exist until now. So these are lingering headwinds against the stock market. First of all, is the Russia-Ukraine crisis. The war now entering day 230, and there was no sign of an imminent end to the war, and worse still, Russia recently announced partial mobilization of its people of the army, and threatened using nuclear weapons. And the U.S. had also warned the Russia the use of nuclear weapons. So this is one crisis that the stock market has been facing since March, the start of the Russian-Ukraine war in March this year. And then the second factor is also a geopolitical factor, which is the US-China relations and tension over Taiwan. Lately, the US government has announced restriction caps on exports of semiconductor technology related to the semiconductor industry to China. So this shows that there's no easing in the friction between the U.S. and China. Worse still, the tension is getting more intense. Another factor also pressurizing global stock markets is the Fed monetary policy, a hawkish Fed. So yesterday, one of the governors, the Fed governors, reiterated that he expected the Fed fund rate to rise to 4.5% in 2023. We reckon that we expect even earlier than that, that the Fed fund rate will rise to 4.5% by the end of 2022. And the Fed governor also stated that next year the interest rate would probably stay at the Fed fund rate would probably stay at 4.5 level, and investors should not expect a rate cut in 2023. So that is negative to the stock market. Okay, because of the aggressive monetary policy adopted by the Fed, so increasingly markets are worried about a recession, a hard landing. And recently, the Fed has lowered economic growth forecasts for this year, especially and as well as next year. Not only the Fed has lowered an economic growth forecast, but also the IMF and World Bank they have also lowered global economic growth forecast. Okay, another headwind that the stock market is facing is yuan depreciation. So the onshore yuan and the offshore yuan, CNY and CNH, both weakened past the key level of 7 yuan per US dollar. In view of the trend that US interest rates are to rise further, we expect yuan will continue to come under pressure before the end of the year. So a lot of the companies listed in Hong Kong are Chinese companies. Their business, their revenue, they generate the revenue as well as the profit and the assets they hold are all renminbi, yuan assets. So a weakening yuan will also be negative for those companies. On the economic side, China is still adhering to its zero COVID policy, which implies that nearly one-third or one-fourth of its population, around 300 million people, are under some form of COVID lockdown, and that affects the manufacturing as well as the service industries in China. In addition to that, China's property woes deepen. I think you have read a lot of reports about the incompleted property, people threatening not to repay their mortgage because of the incompletion of the property. So prices, sales, and investment continue to drop in recent months, despite there are already policies to prop up the property market. But we think these policies will take time to show their impact on the property market. And the last headwind is also related to US-China relations. That is, Chinese stocks may be delisted from the US stock exchanges. Now PCAOB, the task force from the US, they have started the inspection, the audit inspection of those Chinese stocks listed in the US. They started the audit inspection in Hong Kong, but so far the progress is not too encouraging. Some companies fail to satisfy the audit inspection by providing sufficient document for inspection. Okay, so these are the lingering headwinds that are pressurizing the stock market. If we take a deeper look at the China's economy, we'll see the slowdown more because of the zero COVID policy. Despite that, the fact that the Chinese government has rolled out various policies to try to support the economy. China's GDP expanded 2.5% year-on-year in the first half of 2022. Most of the growth was in the first quarter, actually. GDP growth slowed down to 0.4% in the second quarter because of softer external demand and also the pandemic, the COVID outbreaks that started in the second quarter this year in Shanghai and Beijing, and subsequently spread to other parts of China. And also the financially troubled real estate sector, the property market crisis that I mentioned earlier. So we expect also soft, weak figures in the third quarter at this, as the lockdown in some of the cities or provinces still continue. And worse still was the power shortage caused by the climate. The summer months was marked by extremely hot temperatures in parts of China, especially in Sichuan, where a drought caused a decline in hydropower generation, prompting temporary power rationing in some regions. And the manufacturing sectors are hurt by this power shortage that happened in summer. Unemployment rate has been edging up, especially for young people, ages between 16 to 24. It came down slightly to 18.7% in August. Yet, by itself, you look at the absolute percentage of 18.7% is a very high figure. Far higher than the overall unemployment rate in the cities, which was only 5.3% in August. Okay, so I think China is facing this key issue of rising unemployment, especially among young people. So there are not enough job creation for the young people. That this is one area the Chinese government needs to resolve. Okay, real estate investment worsens as being shown by FAI data, fixed asset investment. In fact, fixed asset investment edged up slightly in the first 8 months compared to the first 7 months this year. Fixed asset investment grew by 5.8%, 0.1 percentage point higher than the growth rate in the first 7 months. It was because supported by infrastructure investment as well as manufacturing investment. Infrastructure investment grew by 14.8% year-on-year in August, up from 12.6% in July, largely thanks to ongoing stimulus from the central government. So China, as in the past, is using infrastructure investment to support the economy. Besides that, manufacturing investment also grew quite rapidly, increased 10.7% in August from a year earlier, after recording a 7.6% growth in July. However, the chart on the right-hand side shows real estate investment, which is still suffering. The growth rate worsened to 7.5%, negative growth rate, 7.4% in the first 8 months this year, a deterioration from the 6.4% drop in the first 7 months. So real estate, the property market, still don't see much improvement despite the launch of many supportive policies so far. The chart on the left-hand side shows property sales in the last 8 months. The yellow line represents sales in terms of floor area. So in terms of floor area, you can see that sales was down 23% in the first 8 months, only slight improvement from the 23.1% drop in the first 7 months. So there's not much improvement actually in property sales. The blue line represents sales in terms of value. So in terms of value, property sales dropped 27.9% in the first 8 months, a slight improvement from the 28.8% drop in the first 7 months. The right-hand side, the chart on the right-hand side is the so-called Real Estate Climate Index, which is a gauge of the confidence level of property developers. So above 100 implies property developers are upbeat about the prospect, the future outlook. Below 100 means they are pessimistic. So now the climate index, Real Estate Climate Index, saw a I think it's 2-year, 3-year low. It has dropped to 95, around 95 level, which is 2-3-year low for the index. And the woes in China's residential property market we expect to deepen this year as home buyers remain cautious about China's growth prospects and concerns about project incompletion. Property sales are expected to slump 24.5% in 2022. That means we don't expect much improvement in the last 4 months this year. And new home prices also are expected to fall 1.4%, average home prices in China in 2022. Okay. Industrial output growth accelerates slightly in August because of relaxation of the lockdown in June and July, but that was quite brief. And also it was boosted by the car production. You can see that passenger car production surged by 33% in August compared to a year earlier. But other segments such as cement and steel, they are more related to the property market, still show year-on-year decline in industrial output. So we can conclude that the recovery, the slight recovery in industrial output is not broad-based. is more related to the car industry. It's more led by car production, whereas the property the property developers as well as industries related to the property market are still in a sluggish mode. Retail sales rebounded in August at a faster pace, and it was the fastest pace since the January-February period this year. It grew by 5.4% in August, higher than expectation, attributable also to the car market, to strong mobile sales, which surged by 15.9% year on year, thanks to policy support, including tax cuts and subsidies. But we are not so upbeat on the auto market in China for the rest of 2022, because we are worried that the pent-up demand has been met in the last few months. Those who want to buy cars have already bought and owned a car. And if you look at share price always run ahead of the economy as well as earnings, business results. You can see that auto manufacturers, stocks of auto manufacturers are fared very badly lately, including BYD, which is supposed to be the best among the auto makers in China. The share price are under tremendous pressure. I think it reflects the worries that demand will see weaker demand going forward because of despite that there are continuous policy support, policy support to the auto industry. Yet, because of demand weakening, so the outlook is we expect a dim outlook. Restaurant revenue rebounded in August to post growth of 8.4%, up from 1.5% contraction in July. However, we are also worried that this rebound in restaurant revenue may be also quite brief because of renewed lockdown due to the COVID pandemic. Online sales of physical goods rose by 12.8% in August from a year ago, faster than the 10.1% growth in July. But now online sales in China has also reached a level of slowed down quite considerably from the 30-40% growth in the past. Now I think posting more than 10% growth rate is already very outstanding. And in future, we will not be surprised to see online sales growing at single digit because of the maturing market. Okay, but one thing positive for the China's economy is unlike in the rest of the world that suffer from rising inflation or even hyperinflation. In China, both CPI, Consumer Price Index, and Producer Price Index are falling and are expected to continue falling. The chart on the right, left-hand side shows the CPI. The blue line is year-on-year change, and the yellow line is month-on-month change. So China's CPI edged down from a two-year highs of 2.7% year-on-year growth to 2.5% year-on-year growth in August. Excluding food and energy, the index actually only rose by 0.8%, reflecting lackluster demand. PPI also continues to fall. It rose only by 2.3%, the slowest pace since February 2021 due to falling energy and raw material prices. So this can be viewed as the silver lining in China's economy, because slowing inflation could give some room for the central bank to implement easing monetary policy. Okay. If you look at the recent PMIs, it's quite disappointing. Manufacturing and services activity shrinks amid, I just mentioned, renewed COVID lockdown or restrictions. The chart on the left shows the official and Tyson Manufacturing Pmi. So the purple one is the Tyson Manufacturing Pmi. You can see the official manufacturing PMI in fact rose to 50.1 in September from 49.4 in August. Again, entering expansion territory. But the non-manufacturing gauge fell to 50.6 on the right-hand side, the blue line. Tyson market manufacturing PMI continue the contraction. It fell to 48.1 in September from 49.5 in August, marking the second month of contraction below the 50 level. The services PMI is more worrying. It fell to 49.3 from 55 in August as COVID containment measures disrupted supply and demand and restricted national travel. Okay, so both Tyson manufacturing and services PMI are in contraction territory in September. This is not a positive sign for the next 2-3 months. So we do expect the Chinese economy will face more challenges in the next 2-3 months. But it depends on more if there are more supportive policies announced during and after the People's Congress, the 20大, that will be convened starting from 16th of October. If there are no new stimulus policies, then we expect a challenging fourth quarter for the Chinese economy based on the PMI and also the COVID situation, the pandemic restriction being implemented recently. Okay, so I think for China, a lot of policies, supportive policy and stimulus policy have been announced to prop up the economy. Yet one key mitigating factor is its commitment to its zero COVID policy. So despite that, there are already a lot of supportive policies being announced, the zero COVID policy will do disruption to the supply chain, as well as it will also adversely affect both the manufacturing and services sectors in China. And lingering crisis in China's property market worsens conditions. It is estimated that nearly a third of all property loans are now classed as bad debts. So we also don't see imminent resolution to this property issue in China. It will take time for confidence to be rebuilt and for potential home buyers to come back to the property market. It will take time, we believe. Aggressive global monetary tightening and higher domestic inflationary pressure have limited room for further easing. The PBOC had announced rate cuts a few times this year, yet the percentage, most of the rate cuts come in 10 basis point to 15 basis point every time. So I think PBOC is also wary of the inflationary environment, global environment of inflation. So it does not take aggressive steps in reducing interest rate. Okay, so we further lower our GDP forecast growth for China this year from 3.5% in our last presentation. Now we lower the GDP forecast growth this year to 3.3%. Okay, the yuan is under pressure because which is attributable to a few factors that are stated here. First of all, China is at a completely different stage in the economic cycle to the United States. United States is facing high inflation. The Fed is focused on fighting inflation, while Beijing's priority is supporting the pace of economic growth. So we saw the PBOC cutting interest rate a few times this year, whereas the Fed continues to raise rates since March. We expect the PBOC to continue to cut interest rate further, which will widen the gap between US and China. Now the yield gap between the benchmark 10-year US Treasury bond and its Chinese counterpart hover at the widest level since 2007. And we expect this this yield gap to widen further if China is about to cut interest rate again. I think for the US, they'll continue, is for sure that the Fed will continue to raise interest rate in November and December. So this yield gap between US Treasury bond and its Chinese counterpart will widen further. Beijing's strict adherence to its zero COVID policy, plus an imploding property sector and a large government funding gap will continue to weigh on growth and also weigh on the yuan. Although China's, the PBOC has announced measures to slow the pace of the yuan's fall and also had made verbal remarks about aiming to support the yuan, yet we saw limited impact so far. So we expect yuan to continue to weaken because of a strengthening US dollar. It may test, this is offshore renminbi, CNH. It may test the support of 7.3 against the US dollar before the year end. If there's any rebound, maybe due to temporary weakening of the US dollar, which we also witnessed two weeks ago, we expect the yuan to have resistance, to meet resistance around 7.1 against the US dollar. So for the fourth quarter, we expect a rather tight range between 7.1 to 7.3, but the bias is still for the yuan is a downward bias. For the US dollar is an upward bias. So we still expect a downward bias towards 7.3 for the yuan. Okay. Q4 index targets. Before we talk about our estimated index targets for the fourth quarter, I would try to deal with the question of this I posed before the commencement of this presentation. How long will this bear market last? Okay, so by looking at historical data, among bear markets, US, let's talk about US bear markets first. since 1946, among the bear markets since 1946, the average decline, if sometimes bear markets may not come together with a recession, but most of the time when there's a bear market, there's a economic recession, although the two may not come together. So survey shows that if there's a recession, the average decline of the U.S. market was 36%, a 36% decline from the highest point, the peak in the last bull market. And if there's not a recession, the average decline was around 28%. Okay, so remember these two numbers, 36 and 28%, the average decline with recession and without recession. So for Dow Jones, it reached peak around 36,950. And if there's a recession, it is expected to drop to 23,650 based on an average decline of 36%. We calculate that way using the peak of 36,952 and assuming a 36% decline. So with recession, the Dow Jones Industrial Index is expected to fall to 23,650. And without a recession, it is expected to fall to, on average, based on the average decline of 28%, is expected to hit a bottom or fall to 26,600. So based on the last close yesterday, Dow closed at 29,202. That means if using the average figure for estimation, there was 10 to 20% more downside for the Dow from current 29,000 to 26,600, or if there's a recession, it may drop to 23,650. As for the S&P, we take the highest, the peak, 4,818 peak, assuming a 36% decline. If there's a recession, it will drop to 3,083, 3083. And if there's no recession, we assume based on the 28% decline, it is expected to drop to 3,469, around 3,470, which implies a 5 to 20% more downside compared to the closing of 3,612 yesterday. Okay, for Nasdaq, it always moves ahead of the Dow Jones and S&P. Technology tech stocks always move faster. So assuming there's a recession and a 36% average decline, the Nasdaq is expected to drop to 10,375. And without recession, it is expected to drop to 11,673. But yesterday, interesting to note that the Nasdaq closed at 10,542. That means it has dropped more than 28%. So if Nasdaq is correct, if is signaling a recession, if Nasdaq runs ahead of the other indexes, Nasdaq itself from the index level actually is signaling a recession in the US economy. So if there's a recession, Dow may fall to 23,650, another 20% downside from the current level. And S&P may fall to 3,083. So that's the on the US market for your reference. As for the Hong Kong market, we saw 4 bear markets. This is the fourth one. The previous 3 bear markets, the decline ranges from 36% to 66%. The one in 2007 and between 2007 and 2008, there was very severe. Hang Seng Index dropped from a high of 31,958 to 10,679. The drop was 67%, around 66, 67%. I think that the drop that in 2007 was so severe is because it was triggered by the Asian financial crisis, and also the collapse of the Lehman Brothers, and also slump in the property market. So it caused such a huge drop in 2007. And then 2015, the Hang Seng, the Hong Kong market also saw a bear market between 2015 and 2016. At that time, the Hang Seng Index dropped from 28,589 to 18,279. So this time round, the decline was 36%, more moderate than the bear market seen in 2007. And then in 2018, this again, we saw another bear market on the Hong Kong market, which was triggered by the COVID. COVID started in 2019. Actually, the bear market kicked off in 2018. So it dropped from a high of 33,484, 33,484. This is the Hang Seng, and dropped to a low of 21,139, representing a decline of 37%. Okay, so coming to this bear market, which started in 2021, the Hang Seng started to fall from a high of 31,183. Currently, today, it saw a day low of 16,820. So from 31183, dropping to 16,820. The Hang Seng has dropped 46% from the peak. So this, just look at the percentage drop. It is more severe than the bear markets in 2015 and in 2018. I think one reason is in 2015 and 2018, the drop was more moderate because with the help of a U.S. market, the QE implemented by the Fed, so that mitigates the blow dealt by the bear market. But this time around, the U.S. market, the Fed is tightening and also shrinking its balance sheet. Together with China economic growth rate showing a more significant slowdown, so the impact on the Hong Kong market is more being felt. This time round is already down 46%. So assuming a 50% drop from the recent high of 31,183, the Hang Seng is expected to drop to 15,600. 15,600. This is based on a 50% drop estimate. If the bear market this time is to decline more, is to drop more than 60%, then we are looking at a index level below 13,000, around 12,500. But for the time being, we are not that pessimistic. So we assume the drop will be around 50%. Now it's 46% already. So 50%, we'll be looking at index level of 15,600. But for the fourth quarter, we expect the Shanghai Composite Index to trade within a range of 2,900 and 3,220. Yesterday, it closed at 2,978. So there may be more downside in the near term. Okay. For the Shenzhen Component Index. The forecast range is 10,100 and 12,000. 10,100 and 12,000. For Hang Seng, our forecast range for the fourth quarter is between 16,500 and 19,200. Hang Seng Tech Index, our forecast range is 32,050 to 4,000. So in fact, now it's very close to our the lower end of our forecast range. But of course, this is our forecast range. There's no warranty that it will not, if the sentiment remains bearish, there's no warranty that it will not drop even further to test the 3,000 psychological threshold. Okay, we'll focus more on trading opportunities because as the market continues to trend down and there's no clear sign when it will bottom out, I think we advise investors to adopt a trading strategy, that is, sell into the rally and buy at dips. Now we think it's still not the time to for long-term accumulation because we expect the market will not bottom out yet. So the strategy we advise for the moment is a trading strategy. You assume a range, a trading range, and then you can have a flexible strategy by shorting the stock by going short when it into a rally and buying on dips. Okay, Alibaba actually the growth stagnates in the first fiscal quarter ended 30 June 2022. Revenue was 205 billion yuan, down 0.1% year-on-year due to a 1% decline in China commerce segment revenue. And revenue of its once fast-growing cloud business only grew 10% to 17.68 billion yuan. The cloud business has been one of the very promising growth engine for Alibaba at one time, but now its market share is being eaten up by namely the telco operators in China. So China Mobile and China Telecom, they are expanding very aggressively in the cloud market, and also with policy supports because the Chinese government do advocate state-owned enterprise and as well as government departments and organizations to use the telco operators for their cloud service instead of using the service provided by private operators. So that is negative to Alibaba. Net profit attributable to ordinary shareholders in the first fiscal quarter ended 30 June this year plummeted nearly 50% to 22.73 billion yuan. And China's zero COVID policy and the lockdowns are expected to remain a drag on the company business performance. For instance, the e-commerce business will be affected by this lockdown, and there's a lack of catalyst in the short term. We're still is also facing potential disposal from its strategic investors. SoftBank, which owns about 24% of Alibaba, is in the process of slashing its stake to about 15%. So that would bring about downward pressure on the share price as investors are worried about the disposal. And the listing risk, although it was reduced with China allowing the US to access the audit records for US listed Chinese companies, yet Whether their positive results are still remain unknown. Whether this delisting risk is totally dispelled is not known yet. Okay. So we expect trading range between $65 and $92. Near-term support would be 71, and next support would be 65. 71 is in fact the year low seen in March this year. So far, Alibaba has not breached the support of 71, that is the year low yet. So we expect the key support around $71. And if that support level is being breached, the next support level will be 65. And near-term resistance is 84. Above 84, the next resistance level will be 92. So for those who are trading TLC, with Alibaba as the underlying, you can refer to the this estimated range to trade. That is, you can go long around 71 and sell or even go short around $84. Okay. Tencent is also recorded the first revenue decline since 2014. So both Tencent and Alibaba, these fast-growing tech companies in China, they are facing slower growth, both in revenue as well as earnings. Total revenue for the first half of 2022 declined 1.5% year-on-year to 269.5 billion yuan, and net profit dropped 53.5% to 42 billion yuan. Its gaming business continues to face regulatory pressure. Once for 14 months, there was a freeze on the issuance of new games, and it only finally received approval to issue new games last month after a 14-month freeze. So the gaming business is under regulatory pressure, and the advertising business also face challenges because of the weakening economy, the pandemic, the COVID lockdowns, and also the slumping property sector. Divestment of its investment portfolio may further weaken the ecosystem it has built. So it has distributed Jingdong JD to its shareholder as a form of divestment, and also there are talks that it plans to dispose of the shares it holds in Meituan. So in the past, this investment is believed into different fast-growing companies, is believed also to be beneficial to the company, as it will build an ecosystem or expand the ecosystem for the company with investment in different companies, different industries. But now, divestment of those investment portfolios made in the past may weaken the ecosystem it has built, and also weaken the profitability of the company going forward. Like Alibaba is also facing the pressure of major shareholder trying to sell down on the shareholding. Naspers, which owns 29% of Tencent through process, has said it would gradually sell Tencent shares to fund repurchase of its own stock. So Tencent itself has announced that it will repurchase, buy back its own share, its own stock, trying to support its share price. But again, so far there's limited impact on the share price, and also it is believed that if Tencent is to continue to buy back shares, it will need to divest more of its investment portfolio to raise funds for share repurchase. Okay, Tencent, actually this is a bit outdated. The near-term support should be 260. Yes, 260. And the next support is expected to be around 232. Okay, 260 and 232. Near-term resistance, 285. That's already updated. Yes, this is our updated resistance level, 285. And the next resistance level, about 285, will be $300. 300. Okay. Meituan, if you ask me about the fundamental of the company, I think it fares better than Alibaba and Tencent. Its core business did show growth momentum as well as recovery. Its core business include local commerce segment, which includes food delivery, 餐饮外卖, and the in-store hotel and travel businesses, as well as the in-store shopping division. These core local e-commerce segment reported an operating profit of 8.3 yuan, 8.3 billion yuan in the second quarter this year, up from 4.7 billion in the first quarter. So it's it nearly doubles, supported by an improved margin in on-demand deliveries. Its new initiative segment, which includes its community e-commerce service, Meituan Select, Meituan Youxuan, also saw its losses being reduced by 2 billion yuan in the second quarter this year, compared with the first quarter, through more rational pricing, disciplined incentives, and improved efficiency. I think it's also aware of the trend that its growth is slowing down. So there are reports this week that Meituan is planning to expand into overseas markets, with Hong Kong as the first stop to address the slowdown in domestic growth. Okay, but a negative would be Tencent looking at selling stake in Meituan to fund buybacks. This will remain an overhang on the share price. Okay, until today, its share price saw solid support, good support around $159. Yet today, it has dropped below this support level is being breached. So the next support level we expect to be 144. It has dropped below 159 today, and we expect next support level to be 144. Near-term resistance will be 180, and the next resistance level is expected around 200 Hong Kong dollars. Okay. Xiaomi, we expect the profit margin of the company continue to be pressurized by its own move to premiumize its products. It's trying to go premium, to go for premiumization, to roll out more high price products. Its revenue declined 12.8% year-on-year in the first half this year to 143.5 billion yuan, and net profit plummeted, nearly 95% to 834 million yuan, hurt by decline in demand for smartphones in China, Europe, as well as other markets. Gross profit margin also decreased 0.7 percentage points to 17.1%. We expect margins to remain under pressure with premiumization due to aggressive expansion of offline stores and investment in EV, electric vehicle. So this will is expected to burn a lot of money for Xiaomi, opening more stores to market its premium products, as well as the investment in electric vehicle. Yet, as I mentioned earlier, the electric vehicle market in China is the competition is getting more intense. You can see that in the past, the three new forces, 3个新势力，牛、蔚来、小鹏 and Li Auto, 理想. In the past, it used to be the top three best-selling car makers among the new forces. Now, in recent months, their top three positions actually have been taken up by the even newer players, such as Lazha and Lingpao. They have made their way into the top three, with new only remaining still in the top three. Other are being squeezed, being under squeeze. For Xiaomi, also there's another threat, that is India. India has become one of its most important markets outside China. And Xiaomi accounts for about 21% of India's mobile phone market, partly because of its cheap, its handsets are cheap enough to attract the consumers in India. But now India, trying to protect its own smartphone manufacturing industry, is getting hostile to Chinese competitors, including Xiaomi. So it may face more headwinds in the Indian market. Okay, so the share price was quite weak. You see a very clear downtrend starting from late June, and the rebound was not very strong one. There were rebounds in the last few months, yet the rebound were quite soft or subdued. Near-term support is expected at $8.50, and the next key support level is $8. Near-term resistance will be $9.50, and the next resistance is $10.50. Okay, let's come to BYD. It still holds #1 market share in China as well as in the world, if new energy vehicles are concerned. BYD sold 1 million, more than 1 million, 1.18 million new energy vehicles in the first 9 months of 2022, up nearly 250% year on year, already exceeding the lower end of its 2022 sales target. Its 2022 sales target is set between 1.1 million and 1.2 million. So up to end of September, it has already sold 1.18 million new energy vehicles. So I think without any, it's quite sure, for sure, that it will exceed its annual sales target this year again. Its market share in the Chinese EV market reached 24.7% for the first 6 months of this year, representing an increase of 7.5 percentage points from last year. So last year, its market share in the Chinese EV market is below 20%, whereas in the first 6 months this year, it has reached 24.7% market share. That means every 4 cars sold in 4 EV electric vehicles sold in China, 1 belongs to BYD. In the first half of 2022, the group recorded a revenue of approximately 150.6 billion yuan, representing a year-on-year increase of 65.7%. And the profit attributable to shareholders of the parent company increased by more than 200 times to 3.595 billion yuan. So the fundamental for BYD remains healthy and solid. Yet there was one overhang negative factor pressurizing its share price, and that is from Warren Buffett. Warren Buffett has actually started trimming his stake in BYD, and this has so far dented the share's performance this year. As of last month, Berkshire Hathaway still hold 18.84% in BYD. So we are not surprised to see the share price every time when it rebounds, it met selling pressure because investors want to sell before Warren Buffett unload his shares, maybe at an even lower price. Okay, so we expect near-term support to be around 182. Next support, there's a typo error here. It should be 175. 175. Near-term resistance 200. Next resistance will be 210. Okay, so we do not expect a very wide range for BYD. The bias is still downward. There's still a downward bias for the share price because of the Warren Buffett overhang. Okay, another automaker, Geely Auto, unlike BYD, its profit margin is under bigger pressure. In the first 9 months of 2022, Geely Auto sold a total of less than 1 million vehicles, representing an increase of only 7% year over year and accounting for 61.9% of its 2022 sales target, which is 1.65 million units. So the first 9 months represent 3/4 of the year. So the average rate, it should have achieved 75% of its annual sales target if it's to meet the annual sales target. But now it's only achieved 61.9% of its 2022 sales target. So I think it's very, very likely that Geely will again be not able to meet its sales target again this year. For the last 2 years, I think at least 2 years, it has failed to meet the sales target. So it's a bad, it will take as a bad sign by the market as failing to achieve the sales target or having the need to revise downward the sales target. That would not be good to the share price. In the first 9 months this year, Geely Auto sold a total of 439 new energy vehicles, surging 432% year on year and accounting for 23.3% of its total vehicle sales. So in terms of new energy vehicle sales, I think Geely has not done as badly as on the whole. It has done quite well in terms of new energy vehicle sales, as it now accounted for nearly 24% of its total vehicle sales. However, total revenue, total revenue increased by 29% in the first half this year to 58.2 billion yuan. But gross margin ratio was down 2.6 percentage points to 14.6%, negatively affected by the higher raw material costs and the increase in the proportion of NEVs. Production costs are for NEVs, new energy vehicles, are much higher than traditional fueled driven vehicles because of the battery and also because of rising lithium prices that push up the battery costs. Okay, as a result, the group's profit attributable to the equities holder was down 35% year on year to 1.55 billion yuan. We expect near-term support at $9.80. It's still trying to hold above $10, but we are doubtful it can hold above $10 long enough. So if we'll put the near-term support at $9.80 and the next support at $9. Near-term resistance is expected to be around $11, and the next resistance is $12. Okay, Galaxy. This is one stock that fared that has outperformed the market so far this year because of expectation of COVID travel restriction to ease further. In the first half this year, actually Macau had experienced a COVID-19 outbreak, and the Macau government requested suspension of all commercial activities for more than 10 days, from 11th to the 22nd July this year, which further impacted visitation, revenue, and profitability. As a result, the group's net revenue was down 56% year on year in the second quarter to 2.4 billion Hong Kong dollars. And quarter on quarter, it was down 41%, affected by the COVID pandemic. Group adjusted EBITDA was negative in the second quarter, a loss of 0.4 billion versus 1.1 billion Hong Kong dollar adjusted EBITDA in the second quarter last year. And in the first quarter, it's still making profit, positive EBITDA of 0.6 billion. The second quarter, it recorded negative adjusted EBITDA. But its balance sheet remains liquid and healthy. As of 30th June 2022, cash and liquid investments were 29 billion Hong Kong dollar. And excluding the debts, which is around 8 billion, the net cash, the company has a net cash position of 20.3 billion. So that's why among, you notice there's a rights issue recently by one of the gaming companies, Macau gaming companies listed in Hong Kong, namely SJM, because it does not have its balance sheet is more tight. Yes, a more tight balance sheet, not as liquid as Galaxy Entertainment. According to statistics from the Macau Government Tourism Office, over 180,000 visitors, mostly from the mainland, enter Macau during the National Day holiday. So we saw recovery going happening recently, thanks to Macau's epidemic containment situation relaxing, and also promotional festive events, for instance, the fireworks show to attract visitors. And Macau officials have indicated that China would resume an e-visa program for mainland China's travelers and group tours, with plans to implement the relaxed travel requirements in November. So it depends if the COVID pandemic does not worsen, get worse in November. We're expecting more Chinese visitors from the mainland because of the resumption of the e-visa program that covers 4 provinces and 1 city. The 4 provinces includes Fujian, Guangdong, and Jiangsu, and the city is namely Shanghai. So these are the more affluent provinces and cities that we may see more mainland travelers going to Macau in future. But there's one uncertainty all the gaming companies, all 6 casino license holders are facing, and that is the bidding for a new license for the next, I think 10 years, next 10 years after the expiry of the license end of this year. So besides the 6 casino license holders currently, there's one new bidder, and that is from a Genting-linked firm that may challenge the 6 incumbents. But so far, analysts from the industry do not express big concern about this tender. They expect the 6 casino license holder will be able to get their license renewed in due course. Okay. Galaxy Entertainment, its share price rose to a high of close to 50 Hong Kong dollars recently on last Friday. But because of the end of the National Day holiday and also the weakening U.S. market, it saw correction yesterday and today. But we expect support, good support at around 44 Hong Kong dollars, and the next key support level would be 41, between 40 and 41 dollars. Next near-term resistance is around $50, which it has tried to test last Friday. Its share price rose to as high as 49.75. If it manages to rise above 50 to breach the 50 resistance level, the next resistance level will be 54 Hong Kong dollars. So the gaming sector is one of the very few sectors that we are still upbeat on because of expectation of more COVID restriction ease and also more resumption of visitors to Macau. Okay, last company to talk about is WuXi Biologics, Yao Ming Sheng Wu. The results are strong, yet there are other headwinds it is facing. The group's revenue for the 6 months ended June 30, 2022 increased by 63.5% year-on-year to 7.2 billion yuan, together with a 60.3% year-on-year growth in adjusted net profit attributable to owners of the company to 2.835 billion yuan in the first half. So both its revenue and its its adjusted net profit grew by more than 60% in the first half this year. And the total number of integrated projects increased by 30.9% from 408 as at the same time last year to 534 as at June 30 this year, including close to 500 non-COVID integrated projects. So this figure demonstrates that it is not very dependent on COVID integrated projects, COVID projects. The group's total backlog, including the service backlog and upcoming potential milestone fees backlog, increased from 12.465 billion US dollar as of June 2021 to 18.467 billion US dollar as of June 30 this year. So the company has a rather huge backlog to be filled, to be completed in the next 2-3 years. And one good news is one of its subsidiary, WuXi Biologics Co. Limited, located in Wuxi City, was recently removed from the unverified list, UVL list by the U.S. Department of Commerce, effective October 7, 2022. But the other subsidiary, WuXi Biologics Shanghai, is still on the list. So this is deemed as a piece of good news for the company. But there were still dark clouds affecting the company, and that is U.S. efforts to boost biotech industry and avoid risks posed by foreign adversaries is negative to the company's outlook. And actually, the news led to a sell-off in the share price as revenue derived from North America by WuXi Biologics accounted for more than 50%, as much as 54.1% of its total revenue in the first half of 2022 was derived from North America. So if US cuts on its reliance on Chinese companies for biologic biomedic research and development (R&D) would affect adversely WuXi Biologics. It has announced buyback plans for up to $300 million in the open market, trying to support its share price. But so far, there's limited impact on the share price. As you can see in this chart, the share price continues to trend lower despite the share buyback plan announcement. And yesterday, even the announcement of the removal of one of its subsidiaries from the unverified list, the US unverified list, does not help the share price. We expect it may test near-term support around $45, and the next support is $40. You can see in this chart, its share price, the year low was around 41.45, seen in March this year. So its share price is still above the year low seen in March. But it's likely that with this market sentiment and the bias and the weakening bias, its share price is quite likely to test the March low. And near-term resistance is expected around 50 Hong Kong dollars. Next resistance is $55. Okay, so that ends my presentation today. Let me see if there are any questions. I will answer your question. Okay, Henry Lim, thanks for your question. In the broader view, in order for a market to reverse or stop the pace of great sell-off, there must be impetus to it should be stimulate the market into a bull or reversal. Don't see the light as yet. Yes, that's also our view. Francis, for both Alibaba and Tencent, where its major shareholders are reducing the stake, are there any available publication websites showing how much they have sold their latest percent share holding? Yes, you can go to Hong Kong EXF website. They will announce or publicize on the HKEX website the number of shares they have disposed of. But that's kind of lacking indicator because you can only know after the disposal. But there's also one signal to watch, especially for those companies that have listed their shares on the US market. So when they move for the US if the shareholders are from the US, most of the time when before they plan to dispose of their shares, they have to move their shares they are in the forms of maybe ADRs deposited in the US with US outside Hong Kong. They have to transfer the shares to the central clearing company in Hong Kong, the so-called Securities. That's what happened in July this year when people noticed that the Securities holding of BYD suddenly increased by 225 million shares. They saw a transfer of more than 200 million shares of BYD to the central clearing company in Hong Kong. And people check up the holding of Warren Buffett's company. There was exactly the same amount of number of shares, 225 million. So that triggers the rumor. At that time, it was still a rumor that Warren Buffett plans to sell its holding in BYD, and the first move is to transfer the shares to Hong Kong first to facilitate the disposal. And subsequently, it proves that this rumor is true because Warren Buffett, the disposal was being announced and published on the Hong Kong exchange website. So for companies that have shares listed in the US outside Hong Kong, one signal to watch is the change in the shareholding within CCAS, the Central Clearing Company. If you see a sudden increase of shareholding under CCAS, that may imply some overseas shareholders are planning disposal of the shares by first transferring their shares to Hong Kong. Okay. Hang Seng is trading below, HSI is trading below 17,000. Many stocks are trading at 10 to 15 years low, and Hang Seng Tech is hitting all-time low. Can comments on your strategies going forward, buy, hold, or sell? Actually, thanks for the question from E. Fraser. As we do not expect the market to bottom out yet, and it's always difficult to time the bottom. So our strategy, we recommend a short-term trading strategy, that is buy on dips and sell into rally. And we try to just now give you the forecast price range for each individual stock, and then you can refer to those price range and structure your strategy accordingly. Okay, can comments on the outlook of Hong Kong listed China tech stocks? I think I've covered already those three companies, Tencent, Alibaba, BYD. You can refer to my slides earlier. But admittedly, they are more negative than positive for their prospect. Can comment on Chinese insurers, especially Ping An, CPIC, China Life. We are still downbeat on the life insurers, including Ping An and China Life, and more downbeat on Ping An because of its investment and exposure to the property sector. That's why its share price in the past used to outperform China Life. But this year, you can see that Ping An share price actually underperformed that of China Life. And that is because of its heavy exposure to the property sector. Okay, there's only one insurer company we like in the short term, and that is 2328 China Property and Casualty Insurance, 中国财险, because of the booming car market and also the premium for new energy vehicles is higher than compared to traditional fuel vehicles. So this is in favor to the property and casualty insurers such as 中国财险. And also because of the regulation, now in the past there was price competition to garner more business. So a lot of the property and casualty insurers in China are operating on a loss-making basis. They try to win more business, yet those are actually businesses that cause them to lose money. But now, because of regulation on price, on the premium pricing, and also now some of the smaller competitors are being eliminated. So we see a reasonable this so-called what do you call that? 综合成本. That's the cost ratio. Yeah, the consolidated cost ratio for 中国财险 now lies at 96, below 97%. So there's a healthy level of cost ratio. for insurance. So we would recommend to buy 2328 compared to 2318 and 2628. Can you give your views on the banks in China and particular Bank of China? We are downbeat on Chinese banks at the moment. First, because of concern about their bad debts related to the property market, and also to property developers. The loans are owed to them by property developers, and also in harsh time. During harsh time, state-owned banks are always ordered by the central government to service the society, to share their profits with the society. So we don't expect good earnings growth at least this year and next year for Chinese banks. Okay, and also there's fear that the NPL, the non-performing loan ratio, may start to rise because of the property market woes. Okay. I think you are asking about the Seng ETF, but listed in on the Hong Kong on the SGX, issued by Lion OCBC Hang Seng. If you are referring to the Hang Seng Index, which has dropped close to 50%, we think there's still more downside. Just now, I have analyzed using the last three bear markets as an illustration. We expect if this time round, because of expected recession in the US and also tightening monetary policies, hawkish Fed, so that all did not bode well for the Hong Kong market. It may fall to below 16,000 if we are expecting a 50% decline for the Hang Seng from the peak seen in 2021. Okay. What's your view after 16 October CCP meeting? Will China remove or improve on their zero COVID policy? Any other impact on the China-Hong Kong market? It's really hard to tell. I would only say we hope they can remove or relax at least relax the zero COVID policy. Otherwise, a lot of manufacturing and consumption activities, even services, the services industry will be affected. So if there's a relax, I think those travel, tourism related companies such as Trip, 启程 and Tongcheng 旅行, and also the aviation companies, China Air, Air China, Eastern Air and Southern Air will benefit if there's a relaxation of the zero COVID policy. But if you ask me whether they will relax it or remove it, I really have no idea. I really don't know. Hong Kong has good fundamentals, but it's very depressed for a long time. What's the view on this stock? Okay, I think yes, move is to Singapore, and then the fact that it's neglected by Hong Kong investors and also investors that are more active on the Hong Kong market. So this also is reflected in the valuation. Once you are listed in a stock market, on the stock market, there's not, I think it's like, I don't mean to offense, but you also realize that some companies that are listed in Singapore, ultimately they move to Hong Kong. They delist their shares in Singapore and move to Hong Kong. It's because it's less liquid in Singapore, because less liquidity also is reflected on the valuation, translating into lower valuation. So Hong Kong Land, I think the low valuation is partly because of the lower liquidity in Singapore. And the other more sound reason is now the vacancy ratio among Grade A offices in Hong Kong is also going up. This is a fact that vacancy or the occupancy ratio is coming down. First, it's because of the change of, I mean, because of this COVID-19, a lot more people work from home. So there's smaller demand for office space, or companies do not expand their offices as aggressively as in the past. So there's more office space to offer. And in addition to that, it is reported that more and more foreign companies are moving their headquarters away from Hong Kong, maybe to Singapore, or maybe to London or other parts of the world. So this also caused demand for Grade A offices to shrink, which is not not a good sign for Hong Kong Land. Okay. Hang Seng is at low now, which are the good ETF to ride on the rebound. Mean normal ETF, not those leverage ETF. If you look at the tech index ETF, Hang Seng Tech Index ETF, it's more volatile than the Hang Seng Index because of the constituents. So if for short-term trading purpose, you're looking for and also we observed that over the last few months, the rebound was very brief. Every time it rebounded, the broad market rebounded for only 1 or 2 days, 1 to 3 days, not more than 1 week, and then it weakened again. So to capitalize on this short-lived rebound, you need to maybe, of course, the risk is higher. You need to there has more volatility, so that you can, if you enter the market at a right time, the return can be better than than the Hang Seng Index ETF or the China Enterprise Index ETF. So I would suggest Hang Seng Tech Index ETF for short-term trading and for rebound purpose. What's your view on Haidilao? Haidilao, I think, is still facing some uncertain factors that may cloud its prospect. First of all, it has implemented the so-called woodpecker program, 啄木鸟 program, and that helps the share price to recover a bit from the low, the recent low, because the program itself means they are closing down the stores that are less profitable, like the woodpecker. They are taking out the worm from the tree, so that will enhance their profitability, and also keep their cash flow positive. Yet recently, after this program, they said they have ended this program, and now they are embarking on another program called 好像是硬骨头 so they are again aiming to open more new stores. So they are on an expansion mode again. But during this time when COVID pandemic is still uncertain in China, a lot of uncertainty because of the zero COVID policy, whether it is a right move to go on expansion mode again at this point of time, I think is quite highly uncertain. The answer is highly uncertain. Okay, so it's facing two uncertainties. First is expansion plan, whether it will turn out fine this time, and also the pandemic control in China will also affect its future business. So my answer is the outlook is quite uncertain for Haidilao. JP Morgan predicted that recession in US will occur 6 to 9 months time. How will this impact China and Hong Kong? I think we have already price in that, and also from the drop, the Hang Seng index has dropped 46% so far, and the Hang Seng Tech Index has dropped more 40% year to date, just this year, this 10 months or so. We already run ahead of the US. Just now, US, I think, from my analysis earlier, points out that Nasdaq now is down more than the recession, more than 36, let me see, nearly 36, more than 28% average decline without a recession. So Nasdaq signaled that US is entering a recession. So this concurs with what with the call of JP Morgan. But Hong Kong, I think it will follow, continue to trend lower, but it's already reflected in the decline so far on the indexes. So that's why for the Hang Seng, we expect, we are not surprised to see if the index drop goes below 16,000, assuming a 50% correction from the peak seen in 2021. Okay. What is your advice to people who invested in Hang Seng Tech Index, Alibaba, especially the long-term investors? Do you think China market will recover, let's say in 5 to 10 years from now? Now, I think it's hard to tell, because what's affecting the tech companies, China tech companies, not only the economy itself. You remember earlier, since last year, policy change, the curve on the antitrust, the policies targeting the gaming companies and e-commerce. So I think for Chinese investment in Chinese companies, the biggest risk, and also the risk that is most difficult to quantify, is the policy risk. We outsiders can never tell beforehand or predict how the policies will affect those companies involved. So I really think if you for long-term investors or long-term investment in tech companies, there is this biggest uncertainty, most uncertain factor, and that is the policy, Chinese government policy, that will affect the business performance as well as the future growth of those tech companies. And that's really hard, very, very difficult to tell. Okay. NIO is at its lowest around 1352 and it's dropping daily. Do you think it will bounce back? Yes, it may bounce it a bit, but you can see that the bounce tends to be very short very brief, because now the new energy vehicle car market in China, the competition is getting more intense. There are more in Chinese idiom. There's the saying, 僧多粥少, too many monks competing for too little congee. Now, I think the congee, the bowl of congee represented by the new energy car market is still growing, but not as fast as the growth in number of months. The problem in the China new energy car market now is that there are too many new monks fighting for the congee. Xiaomi will launch new energy cars in 2024. Huawei already has launched its new energy cars, and there are reports that another mobile handset manufacturers, Vivo, has also had plans to manufacture new energy cars. So on the one hand, competition is getting more intense, and on the other hand, because of lithium price, the ever rising lithium price, now battery costs used to account for 40% of the manufacturing cost of a electric vehicle. But now it has risen to 60%. The battery cost accounts for as much as 60% of the manufacturing cost of the EV, mainly because of the rising lithium price. So I think all these players, they are facing first more competition from other players, and secondly, lower profit margin, lower gross profit margin, and in order to spur sales, some of the makers are providing subsidy themselves to attract buyers. So this will also pressurize the gross profit margin by offering all sorts of subsidies to lure newer buyers. Okay. I think we'll take one last question. The last three questions are all on companies related to climate change, clean energy. Beijing Jingneng Clean Energy by BY Ang asked about 579 Beijing Jingneng Clean Energy. And Yi Fraser asked about China Everbright, why it has dropped so much. Is it still a new play going forward? And Henry Lim also asked about clean energy. I think over a very longer term perspective, we are still upbeat about clean energy development in China, because China has to go to take that path of promoting clean energy. But in the short term, the promotion of clean energy does not translate into good profits by those players in this area, and also not translated in, not reflected in the share price. Partly because it's mainly due to the subsidy issue, because a lot of clean energy, such as wind power, solar power, the operators, I mean those who operate the wind farms and the solar stations, they will get their subsidy from the provincial government or from the fund, clean energy fund for subsidy. But because of the deferment in payment of those subsidies, so you can see that these companies all have aging receivables from provincial government on the subsidies. So if you look at Everbright China Everbright, 257. Actually, its business results are doing very, very well over the last 5 years. Its profit increased every year. We saw growth. Yet, I think two reasons. First, people are concerned about the receivable. The cash flow part, the profit earnings, the bottom line looks good, but the operating cash flow is affected by the receivable. So that's one concern among investors. And the second concern is now investors is trading on 2 times PE. It's very difficult. It's paying good dividend, yet 2 times PE. What explains is investors at the moment are not attracted by this sector. So the energy, the valuation goes even lower. But if you have enough holding power, I think Jingneng and Everbright, they are both state-owned companies. So at least investors need not to worry about the financial health or the whether the company will go bankrupt. I think that's not an issue. Its own investors, if they have the patience and the holding power, I think over time we'll see a re-rating in the valuation. I think at least the valuation, the PE, should trade in higher single digit to be a reasonable valuation. That means 6 to 8 times should be reasonable. Now is 2 times is too excessively low, but it doesn't mean that there will be a imminent re-rating in the valuation. Investors need to be patient enough for the re-rating to happen in future. Okay, so thank you very much for your time. I hope I will be seeing you soon. And because of this opening up, I hope next presentation would be a physical one. I can see you face to face rather than doing a webinar. Thank you.